Most of us, when we started investing, it was with a very small corpus. Unless we were lucky to have an inherited portfolio from our parents or from our family. And the lure of making a lot of money in the stock market always was there in front of us. When we read about the exploits of legends like, Warren Buffett or Jim Simons or even Rakesh Junjunwala, the dream was very big. And the problem that we always tried to solve for was wealth creation. So we started with very little wealth, and what we tried to get was to a point where we became wealthy. Now, that is probably the case for 99% of the investors. But there is this very small percentage, maybe 1% or even lesser than that, uh, who has a completely different problem statement. And and that set of investors are those who have made their money mostly from businesses, whether their own business or family businesses, or have family wealth. And if they've been doing it, if they've generated the wealth from their business, they've either sold out or taken a substantial portion to create a sizable portfolio. And now, they've invested it and they want to retain the buying power of that money. Usually, this kind of a portfolio takes many forms. Nowadays we see family offices, family trusts, family portfolios of HNI, UHNI individuals. In the last few years, I have been associated with few large family offices, large family portfolios, and have gathered a fair understanding of the psychology of this type of investor, right? And the psychology is different from the psychology of the other 99% of investors who are of my kind, where our endeavor is to create wealth. So the most important aspect to remember is, for this class of investor, uh, investment is not for wealth creation but for wealth preservation. Right here, the objective is not to look for the next multi-bagger, but to ensure that the family retains the buying power at the same level in the next generation. When I first started looking at a portfolio like this was for a family just in the beginning years of COVID, and the capital that was there the family had, it was kind of irreplaceable. They had sold off their business, and this was the money that the family was ever going to have. uh, this was their sole pot of gold, if I may put it that way, right? So the capital protection, preservation, and maintenance of buying power is all that was the primary important factor here. uh, so the question that I asked myself is, how do we preserve wealth, right? And to do that, I think the first important thing is to play good defense and to ensure that you have risk management in place which will ensure your survival. So first and foremost, the way to ensuring your survival is to buy high quality businesses. Longevity and endurance of a business, how long it can survive, how enduring it is, uh, how well it can go through the ups and downs of industrial upturns and downturns, social upheavals, political upheavals, economic turmoil. So how well it can endure was of the most important factor, right? So first, this will ensure that your permanent capital loss is limited, right? So that is the first thing. The second thing is to use is to use a stop loss. Now whenever you are using a stop loss, and I've spoken about this before also, a stop loss sometimes is sacrilegious to many value investors because they think that this is something that only technical traders do. But I personally strongly believe that no investor can know all that is to know about any business or any stock, right? Even the promoters and the management do not know what is going to happen in the next you know 1, 2, 3, 4 quarters. It's very difficult. I mean, most of the time, whenever we interact with the management, we find that they are also equally perplexed, although they don't give that out usually. But in general, and we've seen many cases where management commentary has gone completely wrong, right? So using a stop loss, what it does is it's your insurance against catastrophic loss. This provides a floor to the loss that you can make at any point in time, and it will provide you a lot of mental comfort when you are doing this. And thirdly, you diversify, right? Depending on the size of the portfolio, the diversification would vary. Usually, I would, always like to have between 10 to 20 stocks in the portfolio. But if the portfolio size is very large, right, then you might want to, maybe have a little bit more number of stocks, right? Uh, the next important thing is to look for asset allocation, right? Asset allocation not only in terms of equities, but here you are looking at multiple asset classes. So you have, other than equities, you can look at bonds, gold, silver. So basically precious metals, real estate, both commercial, residential, and so on and so forth. Personally, I am only focused on equities. So whenever I discuss this with these family offices or these individuals, I ask them to go to specialists in each of these areas. But you know broadly, I would always suggest investors to be overweight in equities, because over say a 30, 40, 50 or 100-year period, it is businesses that will generate returns which will beat the inflation, right? uh, Typically nowhere in the world will you have bonds beat inflation handsomely. So if you are the way you have to look for is, if you have 100, for example, if you have a 100-year time horizon, right? So you're looking at intergenerational asset creation, wealth creation. You are going to look for businesses that can last very long, like I said, enduring businesses, and your allocation towards the basket of businesses will be relatively high. But that does not mean that you will be 100% in equities. You should have these other assets as well as a overall portfolio allocation. Then the next factor, whenever we look at factor investing, from a quantitative thought process, you if you're trying to create a defensive portfolio, uh, creating a defensive portfolio means you will look for factors such as dividend, value, large size, those kinds of things. And you can look at combinations of these factors. So you can look for businesses which are large cap with good dividend yield, or you can look for cheap businesses, again, which offer maybe good dividend yield, or large cap businesses which are cheap, or some such combination. So once you build uh, a defensive portfolio, the next important thing is to be able to look for tactical market timing. Now, this is something which again is sort of an anathema for investing gurus, because everyone uh, thinks or says that market timing is something that cannot be done. Now, although it is something which cannot be done reliably, consistently, uh, I think everybody tries to time the market, whether it is through, playing a valuation game, whether it is trying to time it through technical analysis, whether it is trying to time it through sentiment, whether it is trying to time through valuations, and so on and so forth, right? So everybody would like to, time the markets if and when I'm saying time the markets, I'm not saying precisely looking for the top and the bottom, but basically trying to not get it very wrong, right? You're not getting into a cycle in a uh, at a time when the cycle is completely going into a downtrend, right? So tactical market timing is something which is very important. And one way I have thought, is uh, looking at solving this kind of a problem is to look for custom indexing. Now, this is more, slightly on the quantitative side. But when you look at, say, a Nifty index, like, and for a very large investor, say someone who wants to invest 500 crores or 1000 crores or more into the equity portfolio, a good point to start is, say, a Nifty index fund or something similar. But one variant of this could be you customize the index, saying that, okay, I don't want as much exposure to, say, banking and financials as Nifty has. So I want maybe 10 industries or 10 sectors, 10% allocation each, and say top three stocks from each of these sectors. So you have a 30 stock basket similar to, say, a Sensex, or a 50 stock basket. You take maybe five stocks from 10 top industries, and you buy those. So there are different ways of constructing a custom index portfolio, and this can be pretty easily accomplished using slow moving quantitative models. Whenever I talk about quant, a lot of initial assumption is that quant means it's momentum, or quant means it's high frequency. It does not need to, it is not correct. Quant could be anything. It could be used for very long duration investment as well. Once you are done with playing defense and maybe building a core custom index, then the next part is to look for offense, and some part of the equity portfolio needs to go into offense. Or when I say offense, basically what I mean is you are looking for high growth, momentum, uh, and again, this could be slightly longer term momentum or slightly longer term growth portfolios. So typically what happens is longer term momentum tends to work very well over very long periods of time. It has been historically proven that momentum is one factor which is done extremely well for many years uh, in the past. Uh, so, in a nutshell, basically what you're trying to focus on in your equity portfolio, if you have a very large size portfolio, if you're already rich, is to ensure that you have a very dominant defensive positioning, and then you have a minor offensive position. Uh, Offensive as in playing offense. Uh, the other thing, just to summarize, is uh, if you've heard of Daniel Kahneman and the prospect theory, for which Kahneman and Tversky, I mean, Kahneman got the Nobel Prize. It talks about weighing gains and losses, and it's been sort of a lot of analysis has been done, experimentation has been done, and it's more or less proven that for every rupee you lose, your pain is nearly double that of every rupee you gain. So people are much more averse to losses than they are happy about making money. So especially when you have a lot of money, it's more important uh, psychologically to be able to protect it, and that is what we try to do with these kinds of portfolios. And history is replete with such stories of families which were once mega rich, right? But over generations, the wealth has been completely squandered and gone. And we also have instances where uh, wealth has been accumulated and wealth has been passed on for generations, and it keeps compounding at a good, good steady rate. So the crux of this talk is not only for the mega rich or the people who've already made it, but even in our own personal portfolios, especially for people who are maybe working in a job and have created a reasonably sizable portfolio. This is also a very valid approach for them as well. So always remember that playing defense or playing good defense is also a form of playing offense, and especially when your portfolio has you've been able to accumulate a significant amount in your portfolio. So, with that thought, let me leave it here for today. Thank you for listening.